You mentioned it, the 2017 Tax Cuts and Jobs Act. It was something that the Trump administration, when he was serving his first term as president, he put into place. And that was a big change. We're talking about major changes to the tax brackets in and of themselves, a decrease in rates. We're talking about an increase, a massive increase, in my opinion, to standard deduction. And so a lot of that, as you mentioned, was supposed to sunset. And so as an advisor, you and I work with families every single day trying to figure out what decisions they need to make to improve their life. And it's been kind of tough leading up to here because, we're talking about advanced tax strategies or even just simple tax strategies for the everyday retiree like Roth conversions. Well, what do? You don't know. Is everything going to sunset? Are we going to revert back? Are tax brackets going to change, right back to where they were? Because that's a big impact to everybody. Or are they going are we going to have this law passed? Is it going to stay the same?
Welcome to the AMG podcast, helping you stay informed, stay empowered, and stay successful. We're here to help you build the life you were made for and prepare for what's next.
Welcome back to the show. I'm Andrew alongside my partner Mo, and we're two financial professionals that just simply love bringing good education to you and talking about finance, tax strategies, retirement planning, and occasionally working through some of these big new tax laws to ensure everybody's making the right decision. And boy, do we got a big one today.
Oh, yeah, 870 pages plus. Woo. Yeah, well, we knew 2025 was going to be a big year. Sure. There were some tax laws that were going to be expiring and sunsetting at the end of this year. So it wasn't really a secret that 2025 was going to be a really, really big year for financial advisors, investors, and just individuals with respects to their taxes. So July 4th of this year, the One Big Beautiful Act was passed, and there's a lot to unpack in that law.
Well, I think you said it's 870 pages. Yeah, simple enough. That's a lot to unpack.
Yeah,
and what's in there is cuts to spending. Mm-hmm. There's cuts to taxes.
Yep.
There's new changes that are going to be permanent. There's new changes that are going to be temporary. I think above all, though, it all affects everyone.
Yeah.
Right? Everyone. And so, just to work through and hopefully, continue the conversation on how this bill is going to affect the everyday American, no matter if you are, what we call an accumulator, a working family trying to create wealth over time, or you're there. Many of our clients, you're in retirement, you've done a great job, you're successful, and you're trying to figure out how to make sure that you just simply keep the majority of your money and not have to give unnecessary funds to the IRS. So this bill has a lot, and it plays a big part into everybody's life.
It does. So let's jump right into it. So what would you say is the most important thing that everyone should know? Just a blanket, no matter whether you're an accumulator, whether you're a retiree, or anywhere in between. Like, what do you think is the number one thing we should be they should know?
Yeah. So I think you mentioned it. The 2017 Tax Cuts and Jobs Act. It was something that the Trump administration, when he was serving his first term as president, he put into place. And that was a big change. We're talking about major changes to the tax brackets in and of themselves, a decrease in rates. We're talking about an increase, a massive increase, in my opinion, to standard deduction. And so a lot of that, as you mentioned, was supposed to sunset. And so as an advisor, you and I work with families every single day trying to figure out what decisions they need to make to improve their life. And it's been kind of tough leading up to here because, we're talking about advanced tax strategies or even just simple tax strategies for the everyday retiree like Roth conversions.
Right.
Well, what do? You don't know. Is everything going to sunset? Are we going to revert back? Are tax brackets going to change, right back to where they were? Because that's a big impact to everybody. Or are they going are we going to have this law passed? Is it going to stay the same? And so I think to answer your question, one of the biggest things is just getting clarity,
right?
On what's going to happen as we move in to 2026. Now, oddly enough, some of these things, and we'll get to it, like depreciation, and we'll talk about that a little bit later on. Some of these things actually take effect this year,
right?
So, I would say tax brackets because it covers a wide scope of the population, everybody that has taxable income, and then understanding how those deductions also are going to stay put.
Yeah, the tax brackets, basically, they're staying current. as they are right now. They're permanent. And so I like to think that things that are permanent in the federal government are really written in pencil, not in pen, because they can always be changed. But
I got to ask you a question right
Yeah,
here.
go ahead.
What is permanent? I mean, how does Congress even use the word permanent?
Yeah, I know. It should just be temporarily, but there's no, at this point right now, there's no date of expiration, right? Like you mentioned before, some of these changes, they do have an expiration date of either 2028 or 29, but as of now, these tax brackets are set to remain the same.
Right.
So it's the same 7 tax brackets, 10 being the lowest and 37 being the highest. So, for a majority of folks, they've been able to really benefit from the lower taxes that they've witnessed over the last 8 years now. And so the fact that continues is beautiful. And then their standard deductions, again, you mentioned it increased in 2017. Well, it increased again.
Yeah.
Just slightly, but again, a higher standard deduction for singles, married filing jointly, or even head of household. So, you should be able to really benefit from that increase in your standard deduction.
Yeah, let's expand just a little bit on that. So these brackets, you mentioned 10, 12, 22, 24. And so a lot of these brackets were expected to go, I think, 12 to 15?
Yes.
24 to 28. So there were some big leaps in there.
37 to 39, I believe, 39.6.
Right. And look, regardless if you know what all the tax brackets are, I think the simple fact is if they go up, you're going to spend more money, right? You're going to have to pay more money to the IRS, meaning you take home less in a world where everything costs so much. So that was one of those things they said was permanent, right? And I guess to your point, it's permanent without a date of change coming down the pipeline. The other one that was permanent was the standard deduction.
Yeah.
And standard deduction being increased the way it was in the original act back in 2017, I mean, it eliminated this whole need for many Americans to file itemized.
Yes.
Okay. And it matters because, a lot of the tax strategies that we deploy here at Asset Management Group, even things like gifting. We work with a lot of clients that are generous, and they're thinking through, hey, obviously my heart of hearts is to be generous and to give money away, maybe to charity, but I do want to think through how I benefit from that from a taxable standpoint. Well, a lot of people have been giving, and it really doesn't help, because it doesn't break that threshold for that standard deduction.
Mm-hmm. Yeah. So, that was one big thing that happened in 2017 because the elimination of itemization just made things for those who were generous or those who weren't, right? They were able to have a higher deduction just because now, for 2025 and moving forward, if you're single, the standard deduction is $15,750, so almost $16,000 right off the top you can deduct. And if you're married filing jointly, it's like $31,000, or maybe a little more than that. So just right there, especially for a married couple filing jointly, to just be able to erase $31,000 off the top of their income is
huge.
It's huge. But we. I know there were some organizations, some nonprofit organizations that were a little worried about whether they'd see a rise in donations because all of a sudden those that were maybe doing some charitable giving just for the tax purposes, not really because of the generous heart, they wanted to do something to reduce their income. Well, all of a sudden, if you don't have to make that contribution anymore, then I know there were some charities that were worried about it, but there is some things inside the big beautiful bill that does give a little bit of an increase, where you don't even have to itemize anymore to get a charitable deduction. So I think if you're single, I think it's like $1,000, and if you're married, I think it's $2,000.
Right.
So, and that's an above line deduction.
Yeah.
So. And
it happens before.
It happens before, and you don't even have to itemize.
Yeah.
So that's actually pretty cool. So for those charities out there that were worried, at least now there's a little bit of incentive now for even if you're not itemizing, you can still do $1,000 or $2,000 and get the deduction.
Well, I mean, I think anybody that knows us personally, knows our company, Asset Management Group, they understand that we really push for a generous heart, right? We just believe that it creates great impact. We have a responsibility to give back and to help the community. And But there, if you're on that fine line, as you said, like, hey, I do kind of want to give, but I'm also equally focused on the tax benefit. There's strategies like, maybe not giving 1 year, doubling down the following year to try to get above that standard deduction to kind of tap into some of that extra tax benefit. And then on the tax brackets, look, the whole idea of tax planning comes first from the knowledge of what is a reasonable tax rate for someone to pay. And I say someone is in you ultimately. What is the right tax rate for you to pay? And the only way you can know that is to have a plan that's going to detail the expectation of tax rates in the future for your life based off the things we know about your life. And then from there, you can build a plan around it. And so these tax brackets, where they're going to be going into 2026, and this whole word permanent gives us a lot of clarity to begin to execute or continue the process of implementing tax strategy for our clients. So it's, as you said, huge. Now, there were some things that were kind of promised a little bit. I know we were going to throw out one about the HSA plan. I was kind of pulling for this because, they had this idea that you were going to be able to still be have the ability to contribute to an HSA plan after you're on Medicare, okay? And currently you can't do that,
right?
And so they were talking about it. And I'm like, that's unique because
it's a game changer.
It's a game changer because a lot of people that are 65 and older, they're on Medicare Part A and B. They don't. A lot of these little pieces, they just don't have the ability, to use. And an HSA, you think about it. Well, a health savings account, if it's a product used for your health, who needs health coverage and health benefit more than anybody else? The aging population, right? So having the ability to contribute, I was like, man, pulling for that. Didn't happen. One of those things that we just didn't get what we were hoping for. But and there was a few of those really kind of within the plan.
Yeah, I mean, I think another big thing that people were expecting was no tax on Social Security, no federal tax on Social Security. And that was a big push. And quite honestly,
well, that was a push for presidency too. That was like, hey, get me in the office. This is going to happen.
This is going to happen, yeah. And in theory, it sounds like a great idea, right? I mean, when you start thinking about, when we talk to our clients, and especially I remember when we used to do those workshops, and we used to just make fun, but you pay taxes, you pay into Social Security through taxes, and then when you finally get to that age where you're receiving Social Security, you got to pay taxes on that again. So a lot of people felt that it was unfair, right? Almost some way of being double taxed at the same time. But yeah, it was a big push to get nominated, and I think now it's 88%, give or take, should not be federally taxed on their Social Security based off what's in the bill now. So what's in the bill now, if you're 65 years old or older, you get another deduction. So if you're single, I believe it's $6,000.
$6,000, yeah.
And if you're married, filing jointly is $12,000. And that's whether you're receiving Social Security or not. That's just a benefit of being 65 years or older. So so even though it's not federally taxed, with that deduction, you'll see a good number of Americans not paying taxes on their Social Security because now they can add this new senior deduction on top of their standard deduction as well.
Yeah, and you said $6,000 for individuals over the age of 65. If you're filing joint and both of you guys are over the age of 65, it's $12,000. And that number has varied as far as, how many Americans that's going to benefit to the point where they pay zero tax. I mean, look, at the end of the day, all of these deductions create value, no matter who you are, right? It puts more money in your pocket when you get these extra deductions. It just may not fully accomplish what you want. Social Security, for those of you guys that may not know, the benefit actually is not naturally taxed when you start the year. The only way Social Security income becomes taxed is relative to this thing called provisional income.
Right.
And provisional income is almost like this side calculator that the IRS uses, and their bias is they want the tax revenue, essentially. So they want to create this provisional income value to go above a threshold so that they can come over here and grab a portion of your Social Security and make it taxable. And so if you're that individual where, hey, your provisional income is above 44,000 for married filing joint.
Right.
Did I say that right? 44,000.
44,000.
If it's above that threshold, then 85% of your benefit is eligible to be taxed as ordinary income. But then you throw that standard deduction on there, it's definitely a nice benefit. Also, I thought this is pretty unique. You can actually use the deduction whether you are filing standard or itemized.
Yes.
Yeah. So if you're someone who is 65 or older, years or older, you still have a good bit of standard deductions. Maybe you're doing a little part-time gig. We have clients that have, hobbies in retirement that create income, and you can still do an itemized deduction. You still can throw that on top. That's an extra, $12,000 for a married couple, which is huge. But we didn't get the Social Security, no tax, which would have made planning a bit easier. And the deduction's not permanent.
And deduction's not permanent. Yeah. Yeah. So it's almost like a golden window, right now. I think it's 2029 or 2028. I can't remember exactly which one, where this additional...
I think it phases out 28.
28?
Yeah.
Where this additional deduction comes into play. So, that's why tax planning and just financial planning overall is fluid, because you want to make the best decision with the information that you know today. And so as these laws are in place right now, this is a golden window for you to make those decisions right now.
Yeah, for sure. And, just to put some numbers behind it, I'm going to read these off to you guys. But for a joint filer, if you and your spouse are over the age of 65, you basically take that standard deduction, $31,500. You add the $3,200 bonus that was already there because of your age, and then you throw on top of that the extra $12,000 bonus up until year 2028, unless it gets extended. And at that point, you have a deduction of $46,700.
That is huge.
Yeah, that's nice. I mean, we can't complain about that. We didn't get the tax-free Social Security, but it's still a huge benefit for sure.
Mm-hmm.
So that said, let's go on to a few other items, key deductions. Now, this one's big, especially if you live in a state that has high income tax.
Oh, yeah.
I'm pumped about this one personally. Now, Georgia's not what would be considered a high state income tax.
Yeah, but I'm from New York, so I'm sure everyone in New York was just clapping up and down because of the SALT taxes.
Yeah.
And so that was increased from $10,000 to $40,000, and that's huge. This gives you the ability to write off your state and your state, local, and property taxes off your federal taxes.
Yeah. Think about that. Like, you have standard deduction already. We just talked about that as a senior. And then you're taking your state tax and able to add that as a deduction. And for businesses, it's huge.
That is huge. And that was a big one. That was one that was on the ballot, and everyone was looking to see where the SALT tax would go. Where the SALT limit would go. And so again, states like California, New York, that have these high state taxes. This is huge, and it's for individuals or families, I believe, at 500,000 or more of income. So this covers a wide range of individuals who will be able to benefit from this.
Yeah, when Trump initially had his first term, and he put in place this 2017 act, at that time, he's the one that actually reduced it down to that $10,000 limit. Mm-hmm. And there was a lot of conflict at that time about it. And to be honest with you, it was one of those things I was like, oh man, please change. Yeah. Because you're out of your income, you're paying such a significant amount in state tax. And then you're not even you're having to show that still as income over here on your federal, even though all of that money was used for was just to pay the darn tax, you know? So to have the ability to reduce that income that you're paying over here for taxes against your federal liability it's a huge benefit.
That's huge.
Yeah,
that's huge.
For sure. Now, this car loan thing, all right? This one's like brand new. I don't even know if I really heard much about it.
Yeah.
Until the law was put into place.
And it's still kind of, I don't know, it's still kind of weird to me, but what is it? You get to write off $10,000 of interest, but the car has to be manufactured or assembled in America.
Right.
So, I would say lean to your to to your dealer.
shopping at IKEA.
Exactly.
Because you got to assemble everything.
So I would let you lean on your dealer to see if you qualify, if your car qualifies. And I think it's a new car. So I think it's cars that are purchased in 25 through 28 that you get it. So I don't think I'm not quite sure if you purchased a car last year, you'd be able to do it. I think if it's a car from 25 through 28, I guess it's nice, right? Again, anything in my mindset is if we can put things in place where the average individual is paying, unfortunately now these car interest rates are 8, 9, some even double digits, costly. Right? So whether it's the price of the car, whether it's tariffs or whatever it may be, we have a lot of individuals out here that are paying a lot in interest for their cars. So if there's a way for them to be able to deduct some of the interest on it, why not? Right?
Yeah, no, I 100% agree.
But I just don't know, right? How do you tell if a car was fully assembled in America, unless it's like a Chevy maybe, but...
I want to say, I personally want to see a nice deduction for those that have to continue to assemble their cars. I feel like we've had some car trouble recently, and we're continuing to assemble. So I'm like, where's that expense and deduction available at? You know what I mean, Mo?
That's funny, yeah.
So no, but. I think it's nice. Look, it's catered to those $100,000 or less income for single filers, $200,000 or less for families. And you look at, I've always said that you and I had it, I think, a pretty good season of life to kind of get started. We faced, obviously, right around that dot-com bust. We faced the Great Recession as we were trying to get going and getting our families up and on our feet and getting, on our feet as men and as leaders. And the challenge we faced was definitely, reasonable. But I look at it today, and I'm raising 3 boys. You have kids as well, and when you look at the challenges they face as a young family, being able to go buy a home at the cost of, like you said, the interest rates that they are, but the price of the home. You look at vehicles, having to finance where interest rates are right now on vehicles, but then you double down that against the cost of the vehicles themselves. It's like, man. So any assistance there for these families that are really trying to get going, their household income's not like, killing it out there above $200,000. They need the assistance. It's nice to have the deduction.
Yeah, it's a tight squeeze for those. And actually, our intern, Jenna Claire, she wants to be on the podcast. And I was like, you know what? That might be a good idea because, she's young. And I'm interested to see what challenges from a real young professional, like what kind of challenges is she seeing out there? Maybe her friends are seeing, fears, and just be, because what she said I've heard before, but I would love to hear and go a little more in depth with someone in that age range that are, want to buy a home, go to do the American dream, but now it seems like the American dream might not be possible because, your standard starter home is, $250,000, $300,000 with a 6.5% interest rate.
Oh yeah, $300,000 minimum. And in some areas of the country, that doesn't even get you an apartment.
Right.
And the cost of rent is high. Yeah, I feel like you're right. We need something to help get these individuals, these young students, young graduates, off their feet and able to start, their careers. And also too, from a planning standpoint, even middle-aged and people getting closer to retirement, it's all this kind of goes back to just the need to make good, solid, wise decisions. You know, we went through that world where you could, buy a house with no money down and the interest rate's 2-3%. We went through the world where you could buy a brand new vehicle and not even have an interest rate and finance it, right? Those days don't exist anymore. So we also need to be mindful about changing our habits as the cost of buying things have changed and get back to saying, hey, I'm not going to worry about trying to buy the next nicest thing. I'm going to worry about just trying to be practical and buy something that I need that's going to get me from A to Z. And if it doesn't look like what everybody else drives, that's okay. It's like the old Dave Ramsey mentality. Do what others won't so you can live later like others can. And that's kind of, I think, where we really need to shift back to making those good small decisions the right way.
Yeah. Yeah, it's discipline.
Yeah.
Just being very disciplined and having the end in mind. And if you know where you want to be, and that's one of the valuable things that we do for our clients, right? I mean, we're able to project with some assurance in some areas, but with some soft assumptions where you're headed down the road, whether it's your cash flow, whether it's your income, whether it's taxes, and we're able to project that. And by using that, we can keep you accountable, but just be a guide to walk with you through that journey. And then as things change, like a new bill, right, we're able to adapt and adjust and pivot from that plan without it being so concrete and permanent, for lack of better words.
That's exactly right.
Yeah.
And those, the guidance that we provide, the planning, it's just a misconception that it has to be available for those that are in need of a plan, meaning they have the assets, they're worried about things that they should be worried about. Yes, it's important for the wealthy American to prepare correctly and to make sure that all their money's working. But for that, individual who's tapping into that, first big income jump for their family, it's important equally for them, even though they may not have the assets yet, to begin planning correctly.
All right.
So, talk about a little bit of these strategies for retirees in light of some of the new permanent laws in place, things that over the next 3, 4, 5 years, we as advisors, just, be personal and Mo, like, what do we need to be thinking of as an advisor on planning strategies for the next 4 or 5 years?
I think, obviously with all these deductions that we've talked about, I think we're going to see a good amount of people with the ability to start looking at converting some of their pre-tax dollars into Roths. I think this is a good window for Roth conversions,
Absolutely.
quite honestly. You talk about making the right decisions in early on. One of the beauties behind doing a Roth conversion early is you have this bucket that's tax-free to compound over time, right? So what better way to as you're in retirement to start using some of your assets that are tax-free? So again, if some of these deductions do stay permanent, now you've got your income being reduced, and now any distribution from Roth accounts, there's more tax-free income that's coming to you. So while we have this window of a higher standard deduction, while we have this window of RMDs being at the latest 75, and basically, RMDs are required minimum distributions. That's when the government's going to force you to pull assets from your pre-tax accounts. You have this window now. So I think really looking in at converting some of your pre-tax dollars to Roths while we're in this window of a low tax bracket. Mm-hmm. It may, tax planning may not be fun for a lot of folks, and even those who are making making good amount of income may feel like they're paying a lot in taxes. And quite honestly, let's be honest, right? If you're paying 37% federal and 6% state in Georgia, what's that? 43% of your income is being taxed. That's a lot.
That's a lot of money, right?
But if you look historically, we're in a pretty good low tax environment right now. And, part of one side of the one big beautiful bill is that some think that this is going to cause a lot of debt for the country down the road. So we all know that if there's a lot of debt for the country down the road, tax rates may increase down the road.
Right.
So as these laws and these brackets are permanent, this could be a really, really exciting time for those who have a lot in pre-tax dollars to start transitioning it into after-tax dollars.
I could not agree more. And I think the underlying tone there for all the individuals that are listening and watching this show is to not get overly zealous with this comment permanent. It's not an ironclad guarantee. Mm-hmm. So, as far as our methodology here at Asset Management Group and our, outlook for clients, we're looking at it as almost like an administration change, 4 years at a time. We're expecting these laws to stay in place for the next 4 years. Will they change? Who knows? And at that point, we'll figure it out on what to do. Right now, though, we got to plan with what we have and what we know. And tax rates are low. And so Roth conversions are huge. Doing some tax loss harvesting. Okay. Oh, yeah. Being able to manage these taxable accounts effectively, harvesting gains at the right time. That doesn't mean you have to sell your favorite stock and never repurchase it again. Being able to have a well, if you can't do it on your own, which most people don't, but having the ability to direct index or to essentially build the index in which you want to have through the use of individual positions and harvesting consistently, not just waiting to the end of a quarter to rebalance. We've put this message out here consistently. What does rebalancing at the end of the quarter have anything to do with anything, right?
Yeah.
Your money should be actively managed, and you should have an active tax plan and target when it comes to capital gains, short and long-term gains. And harvesting should happen as a regular piece and element to your investment strategy. It should be a part of it,
I agree.
Yeah.
I agree. Yeah. I always find it funny when you say when I hear people say they do the tax loss harvesting either at the end of a quarter or at the end of the year,
which is probably most.
And it's just like, no, I mean, this is something you do every single day, right? But it should be a strategy that you should really, really frequently revisit. I'd also say, in addition to the conversions and in addition to the harvesting, I'd say this is also a good window to start strategizing where you're going to take your distributions from.
Oh, yeah.
Like we all know the bucket strategy where you may have assets that are taxable, tax deferred, and tax free. So we talked about converting. That's converting all your pre-tax to after-tax. But what if you have that taxable bucket, right? When one beautiful thing about, if you think about the story of someone who is getting ready to retire, let's say they are retiring this year, and this is say 65 years old. Let's try to make the story up right now, and here they are facing where they married filing jointly, they have 32,000 give or take that they can do a standard deduction on. Then they have another 12 grand that they can add on as a deduction. And then they have 401k money, IRA money, Roth money, and a brokerage account, right? You now have the ability to start to really do some damage on your tax brackets.
Right.
You can determine what your tax bracket's going to be based off which of those buckets you pull money from. Mm-hmm. So I think with this window, like you said, let's just call it this 4-year window that we're in right now, those that are either retired or really close to retiring and thinking about using some of their assets to fill in any type of income gap, having a strategy on where your income is going to come from in regards to those assets makes a lot of sense now.
Yeah, it does. And then also it helps you determine where and how much risk you can afford to take within certain accounts too.
Yeah.
So like to your point,
double down on that.
Yeah, for sure. So like like Mo's talking about in a scenario like that, you're building a distribution plan, an income plan, okay, so that you can survive in retirement. It's why you save these resources, many of the individuals we work and serve for. And when you have that structure in place, you understand why you're doing what you're doing with certain buckets of money. You've put a job description to certain accounts. It allows you to have the freedom to accept risk in other areas that otherwise you may not want to at your age. This old school thought, and I call it old school because I think it's 100% old school. I think it's outdated. It's not correct. That is that you should be in a target date fund or some type of account that's going to reduce risk over time. And reducing risk because of your age for what? Okay, when you're 35 and 40 years old and you're accepting a lot of risk, you're not accepting it. You think you're accepting it because you're 35 or 40. The real reason why you're accepting it is because you don't need the money.
Right.
Okay. So you get to retirement and you say, okay, well, I now have $2 or $3 million in assets. I'm retiring. Do you need all $2 or $3 million day one? No. What does that mean? That all of your money should be invested at a lower risk level just because you're 65 years old? No. So the same structure that, and basically from a retirement standpoint, you want to build a plan that really reinforces that same thought about investing you've always had. Mm-hmm. I don't need this. And because I don't need this right now, the job description for that money is growth, is aggressive. Inflation and all the things that increase cost of goods are fighting against me. I need it to go.
Good point.
I want to throw one more thing out there that we haven't talked about, and this is for the business owner, okay? So we didn't get this corporate tax reduced. Come on, Trump. Not happy about that. I wanted the corporate tax dropped. He kind of pushed this once again, a part of his campaign. Didn't get done. It is what it is. But what he did do is he took the ability to accelerate the depreciation back up to 100%, and once again made it quote unquote permanent. Now, that is huge. Listen, if you're a business owner out there and you don't know how to leverage accelerated depreciation, you're missing it. You're missing the game. If you are someone that looks at the business in which you operate and you're saying, I want to grow, I want to develop, I want to, be innovative, I want to think and improve every area of my business, the accelerated depreciation, the research deduction, and the improvement of your process inside your business is a monumental, to me, benefit for you to grow and to keep money in your pocket. Accelerated depreciation is huge. And all it is it allows a business owner, it allows an individual that may be purchasing real estate as an investment strategy to go out there and invest in something that's going to improve the well-being of your staff members, allow you to grow your business and employ more people. You get to purchase the equipment, purchase the technology, purchase real estate, and then depreciate it so that you can reduce significantly your tax liability to keep money in the operating account to continue to double down. Once again, if you're a business owner, you don't know how to do that, you're making a mistake. You got to slow down and think.
Yeah. And then the QBI deduction at 20% was another thing that is made permanent now, and so allows you to put deduct 20%.
Right, 20%.
20% of your business income through pass-through entities like LLCs.
Yeah,
and that's huge.
That's huge.
Again, that is
20% is a big number.
That is huge.
Yeah, that's a big number, and there is a little bit of a phase out there at some point,
right.
but that's a huge deduction. You take your P&L top line rev, you run your business, you're left with X. You're now able to literally chop that 20% off down right there before it hits your personal 1040.
I mean, that's perfect. I mean, again, trying to help out the business owner, especially the small business owner. And, again, these are some really, this big, beautiful bill is big. I mean, there's a lot. I mean, there's so much layers that, we're going to go through the bill again. We'll go have another podcast and kind of really expand on
different areas
because there's a lot to unpack here. But, I walked away on July 4th, obviously it's Patriotic Day, but, when this bill was signed, just looking back and say there are a lot of Americans that are really going to benefit from this bill over the next 4 years. With what we've been facing the last few years, right? Rising inflation. We've had unemployment pretty steady at 4%. Rising interest rates, right? Now we get the relief. We get the tax relief that's all indications show that it's going to be a really big win for us. So, yeah, I mean, I think this is a really good bill for everyone.
And I think you said it right. It's something that affects a ton of Americans, and a ton of Americans are going to save a lot of money. That said, you're not going to save near as much as you possibly can unless you have a plan and you know how to actually leverage the laws that are in place. As we always say, you look at who creates these laws, okay? Congress, ultimately, and you think through why are the reasons that they themselves are creating specific laws. Well, they're doing it to motivate particular things, decisions, and when you can think through why a law exists and how can I benefit from it, you can really increase a lot of wealth, untap a lot of resources right there. So, to put a wrap on this, the bill's not going to be, they say permanent, think 4 years. Focus. If you don't have a plan, it's time. Get an advisor, get a tax specialist. If you don't know who to reach out, Asset Management Group, a great resource. We would love to help you guys out just to think through your story. Do a consultation. We could talk about what it looks like to be a client of our firm here. But our goal is just to ensure that the families and the businesses that we work with, that everything that they have created with their time, their energy, their sacrifice, their blood, their sweat and tears is used for their family and their future wealth and generational impact. So you got to do the work, slow down to speed up, make those good decisions.
I couldn't have said it any better. I couldn't have
Thanks,
said it. Well, that's it. So thank you for watching. And like Andrew said, catch us next week. And as always, you can like, subscribe, and share this content with everyone else.